Hi everyone, so we're going to be looking at convertible loans, and a convertible loan is where generally arises where the holder of the loan has the option to either receive payment in cash or in shares. Okay, and the easiest way to demonstrate the accounting for this is if we go for an example. So imagine if I've issued a loan of 100k with free coupon payments of 3% per annum payable in arrears, and the loan was issued on 1st of Jan 22. The redemption date is 31st of December 23. The holder has an option to either receive the 100k in cash or buy 100,000 shares at the market value at that date. The market interest rate on similar loans without the equity option is 4% per annum. Okay, this is per annum, by the way. Explain the accounting treatment. Right, so let's have a look at this. Now, the first thing we need to do is to consider what happens if there wasn't any equity. Okay, ignore what happens if there wasn't any equity. What would we do? Well, we would be paying interest at 4% per annum. Well, our interest charge would be 4% per annum, and we'd be making coupon payments and finally make the payment of 100k. So we're explaining the treatment from the perspective of the borrower. So what we do is we calculate the present value of the liability based on the contractual cash flows discounted at the market interest rate on similar loans. Now that's a bit of a mouthful, but if we explain it using a diagram, it'll be much easier to understand. So firstly, we draw a timeline out, and so we have 1st of Jan 22, we have our year end date, and then we have 31st of December 23. Okay, what cash flows are coming out of the business? Well, you have the 3k being payable in arrears, and then you have the 100k, the principal amount, and then an additional coupon payment of 3k being paid out of the business at this date. Okay, so is our total liability 106k? No, it isn't, and that doesn't make sense because that 106 would be higher than the 100k anyway. So what do? Well, we discount the cash flows at the 4% rate. Okay, so our discount, we measure the present value of the liability at this date. And how do we do that? Well, we discount it at 1 plus 4%. Okay, so 1 plus 4% is 1.04. Okay, and I just want to clarify this is 1.04 to the power of 1 because the distance between this date and this date is 1 year. Right? So our present value of this 3k is 2.9k. What about the 31st of December 23 cash flow? Well, that's discounted at 1.04 to the power of 2 because the distance between this date and this date is how many years? It's 2 years, isn't it? It's an additional year. Okay, so that gives us 95.2. So the present value of the liability is going to be the 95.2 plus the 2.9, and that gives us 98.1k. Okay, so we calculated the present value of the liability at 1st of Jan 22. Okay, and the discount factor is based on the 4%. So I'm just going to put divided by 1 plus discount factor to the power of number of years. Okay, so I'm just being very clear as possible as to what we've done, right? Okay, so we've done that first of all. We've done it based on the cash flows. Next thing we need to do is calculate the equity component of the instrument. Now, the equity component is essentially a balancing figure. We know our present value of liability at this date is 98.1k. That looks like a balloon. So 98.1k. Our equity component is going to be the 100k, which we've issued, 100k minus 98.1k, and that gives us 1.9k. So this is going to feed into our soft P, our balance sheet. The 1.9k is going to sit in equity, and we don't have to do anything else about it. Okay, it's just going to sit there, and we can chill and relax and just be happy with our lives. Fine. Okay, next we need to measure the liability, continue measuring the liability at amortized cost. Okay, and we need to calculate the value of the liability at 31st of December 22. Now think about it, we have a liability balance is going to be initially 98.1k, and between this date and this date we're going to incur interest, and that interest charge, finance charge, is going to be the 98.1k multiplied by the effective interest rate, which you could think of this like effective interest rate. I'm going to put EIR times 4%. Okay, and that's going to give us 3.9k, and that's an expense that hits our P&L. Now, to deal with these kinds of questions, sometimes it's good to have a table so you can figure out what's going on, and do it for both 2 years. So you have the 98.1k, that's incurring interest of 3.9, and then the coupon payment is coming out of here of 3k. So our closing balance is 99k. For the next year, that 99k is incurring interest of 3.96, and then we're taking away a coupon payment of 103k here, and that's going to give us a closing liability of 0, which is expected. Okay, so that means that the model works if we're getting a closing figure of 0, right? So our closing liability at 31st of December 22 is going to be the 99k. Okay, so this is going to feed into our soft P. That 99k is going to feed into our soft P. But the question is, how much of this 99k is current and how much is non-current? Okay, let's have a think about it. Our total liability is 99k, and as you can see, the 99k is dropped to 0, because what happens, even though we incur interest, we make a coupon payment of 103, and that's composed of the minus 99k and the minus 3.96. Okay, so this 103, I know there's been a bit of rounding, but basically this 103 is our final payment. Okay, so that 99k has been recovered next year, so all of the liability is current. Okay, so that 99k has been fully recovered. So it's a bit different from the previous examples we've gone through. Okay, so that's why it's useful to draw the table out, because you then see which bit is current and which bit's non-current, and you can get a mark for saying which portion is current and which one isn't. And a tabular format is always helpful. Right, so just to summarize, convertible loans has a debt and equity component. We calculate the present value of the liability based on discounted cash flows, and the discount factor we use is based on the market interest rate for similar loans where there's no equity option. Okay, so the market interest rate is normally going to be higher than the current coupon rate. In most cases in the exam questions it will be. The step 2 is we calculate the equity value, which is a balancing figure, which is the total amount less the present value of the liability at the date of issue. The third thing is we calculate the closing liability using amortized cost model, and make sure that the finance charge, consider what's the finance charge on the loan, that needs to be expensed to P&L. Okay, and make sure that in your amortized cost model, your table, you're putting everything in the right order. So if it's payable, if the coupon payment is payable in advance, the coupon payment comes before the effective interest rate. If it's payable in arrears, the coupon payment comes after the effective interest rate. And the fourth step is to determine the split between current and non-current, and stating what's current and what's non-current. Okay, and why. And then that's it. So 4 steps, and remember, has debt and equity component. Okay, and try and explain what you're doing where relevant to get as many marks as possible. Hope that was useful, and thanks everybody. Cheers, bye.